Every great fortune starts with a simple question. What if I could make my money work for me? That question has the power to change lives. It builds empires, funds dreams, and gives ordinary people extraordinary freedom. And the place where this transformation happens is the stock market, a vibrant world where money, dreams, and risk intertwine every second. Today, you're about to embark on a journey, not just to learn about stocks, but to discover how true wealth is built. Chapter 1, Masur. What is the stock market? Forget the chaos you see in movies. Traders yelling, screens flashing. At its heart, the stock market is beautifully simple. It's a marketplace where people buy and sell ownership in real companies. When you buy a stock, you're not just getting a piece of paper. You're buying a slice of a real business. If Apple makes iPhones and you own Apple shares, you own part of every iPhone sold. You share in its success and growth. That's the beauty of stocks. They let anyone participate in the world's progress. Chapter 2. Why does the stock market exist? The stock market isn't just about making money. It's a bridge between innovators and investors. Imagine a small company building electric cars. It needs funds to grow, so it sells shares to the public. In return, investors provide capital, and the company expands. Both sides win. The company gets funding, and investors share in future profits. This partnership is the backbone of capitalism. Chapter 3. The psychology of markets. If the market were purely logical, computers would always win. But the truth is, markets are driven by human emotion, fear and greed. When people believe in the future, they buy and prices rise. When panic sets in, they sell and prices fall. That's why understanding psychology is key. A great investor reads crowd behavior, not just charts. The market isn't your enemy. It's a mirror reflecting your discipline, patience, and emotions. Mastering yourself is the first step to mastering money. Every company is made up of tiny parts called shares. The price of each share shifts based on supply and demand. How many want to buy versus sell? When a company thrives, investors expect higher profits, so they buy more, and the stock price rises. But when a company struggles, confidence dips and the price falls. Remember, prices reflect expectations, not just numbers. Sometimes, a great company's stock drops simply because it didn't meet high hopes. That's why real investors dig deeper, beyond the noise and headlines, into true value. If there's one secret every millionaire knows, it's this. Time is the most powerful investor. Imagine investing $1,000 at a 10% annual return. In 1 year, you'll have $1,100. In 10 years, $2,593. In 30 years, over $17,000. That's compounding. Interest earning interest. Growth feeding growth. It's quiet, invisible, and unstoppable. The earlier you start, the less you need to invest. Wealth isn't built in a rush. It's built in rhythm. There are two main types of players in this arena: investors and traders. Investors buy stocks to hold for years, focusing on value. Traders buy and sell frequently, seeking short-term opportunities. Neither approach is right or wrong. They just have different goals. Investors build wealth over time, while traders hone their skills through precision. But remember, both must respect risk. The market rewards those who protect their capital before chasing profit. Stock prices don't just move randomly. They react to news, numbers, and narratives. Key forces include company earnings reports, interest rate decisions, global events, and investor sentiment. For instance, when inflation rises, central banks might hike rates. Higher rates mean costlier loans, which can slow business growth, and stocks may drop. Learning how these pieces fit together is like picking up a new language, the language of money. To track the market's health, investors follow indexes, groups of Top-performing stocks that reflect the economy. The S&P 500 includes 500 leading U.S. companies, while the Dow Jones features 30 of America's biggest firms. The Nasdaq is home to tech giants and innovators. When indexes rise, optimism spreads. When they fall, fear follows. Understanding indexes helps you see the market's big picture, not just individual companies. Starting to invest doesn't require millions, just discipline and a plan. Here's a simple roadmap. Open a brokerage account with a reliable online platform. Start small. Even $50 or $100 can teach you valuable lessons. Diversify your investments. Don't put all your money into one stock. Keep learning continuously. Follow market news, take courses, and seek credible mentors. Remember, consistency beats perfection. Every trade adds to your experience. Every beginner makes mistakes, but the smart ones learn fast. Here are the most common pitfalls. Chasing hype without doing your homework. Selling too early out of fear. Overtrading like it's a game. Ignoring risk management like it doesn't matter. Following social media tips blindly, thinking they're gospel. Markets don't forgive ignorance, but they reward patience and preparation. Your edge isn't in predicting tomorrow, it's in preparing for it. To navigate the market, you need the right tools. A charting platform like TradingView or Think-or-Swim. A reliable news source like Bloomberg or CNBC. A learning journal to track your thoughts and trades. A demo account to practice before risking real money. Great traders use tools not to guess, but to confirm their strategies. The stock market isn't just about money. It's about human progress. When new technology succeeds, lives improve. When a company fails, lessons ripple across industries. Markets connect us across borders, languages, and dreams. Every click, every chart, every ticker represents ambition in motion. Today, you didn't just learn about stocks. You learned about ownership, of businesses, ideas, and your future. The stock market isn't about predicting tomorrow. It's about believing in tomorrow enough to invest in it. Whether you invest $10 or $10,000, you're part of a bigger story. Welcome to the world of investing, where every decision is a lesson, every setback a teacher, and every moment an opportunity to grow. Every great company starts as an idea, often in a garage or a dorm room, just a few dreamers with a vision. But dreams need wings, and wings need fuel, money. This is where the journey from private to public begins. When a company opens its doors to the world, it invites ordinary people to share in its destiny. This is the story of how companies go public, turning dreams into shares and ambition into opportunity. When a company is private, ownership is limited to founders and early investors. As it grows, it needs more capital for expansion or innovation. The company faces a choice: borrow from banks or invite the public to invest through shares. This is where the initial public offering, or IPO, comes into play. An IPO is a company's grand debut, its first step into the public financial arena. It's not just a financial event, it's a moment of transformation. The dream becomes data, and the idea becomes a tradable reality. Before going public, a company must navigate several critical stages. Step 1. Hiring an investment bank to guide the IPO process. Step 2. Due diligence and valuation, where the bank assesses the company's worth. Step 3. Regulatory approval, submitting documents to the SEC for transparency. Step 4. Pricing the shares, balancing excitement with realism. Step 5. Listing and trading, where the company's shares hit the stock exchange. On that day, the dream becomes public, belonging to thousands of shareholders. You might wonder, why would a successful private company open itself to public scrutiny? There are powerful reasons behind this decision. First, going public allows the company to raise huge amounts of capital instantly. Second, Being listed builds credibility and global trust. Third, it provides liquidity for founders and early investors to sell shares. Lastly, public companies can attract top talent by offering stock options. But it's not all glory. Going public means giving up privacy. Every profit, loss, and decision must now be transparent. It's no longer just a company. It's a public responsibility. Now, let's talk about you, the investor. How can you become part of this exciting process? There are two ways to participate in an IPO. First, primary market participation allows you to buy shares directly from the company during the IPO launch. If you're allotted shares, congratulations, you're a shareholder before trading even starts. Second, if you miss the IPO allotment, you can still buy shares in the secondary market once they list. But remember, IPOs often come with hype. Always study the company's fundamentals before investing. Not every IPO turns into a success story. The IPO world is thrilling, but it's not without risks. When a stock first lists, its price can swing wildly in hours. Some IPOs skyrocket 100% on day one, while others crash within weeks. When excitement is high, investors often buy without understanding value, but markets eventually correct themselves. That's why great investors follow a rule. Don't buy the story, buy the business. Study the company's earnings, industry, management, and long-term vision. IPO investing is not gambling. It's about strategic ownership. After going public, a company steps into a new era. Its shares are traded daily, results reported quarterly. Leadership is now judged by the market's gaze. The focus shifts to consistent growth and transparency. Investors, analysts, and media are always watching closely. Every announcement can sway the share price dramatically. If the company excels, its stock can soar for years. But if it falters, the market reacts instantly. That's the beauty and pressure of being public. Let's explore two legendary IPO stories. First up, Apple in 1980. IPO price was $22. Within minutes, the price surged 30%. That day, Apple created over 300 millionaires, many regular employees. Today, it stands as one of the most valuable companies ever. Now, Facebook in 2012. Massive excitement at launch. But technical issues on day one caused chaos and price drops. Yet over the next decade, it grew exponentially. These stories remind us, the market rewards belief, not just timing. Now, let's break down private versus public companies. Private companies have few owners, while public ones have thousands of shareholders. Transparency is limited for private firms, but public companies must fully disclose. Capital access is restricted for private companies, but public ones have unlimited potential. Regulation is minimal for private firms, while public companies face strict oversight. Share trading for private companies is through private deals, while public companies trade on stock exchanges. Going public transforms a business into a public trust. It's not just about money, it's about accountability and growth. Once a company's shares start trading, it gains a new identity. It's market capitalization, or market cap. Market cap is calculated by multiplying the share price by the number of shares. This value tells us how big a company is in the stock market. For instance, if a company has 100 million shares priced at $10 each, its market cap is $1 billion, making it a mid-sized firm. Generally, we categorize companies as follows. Small cap is under $2 billion. Mid cap is between $2 and $10 billion. And large cap is over $10 billion. Understanding market cap is crucial for aligning your investments with your risk profile. Smaller companies might grow faster, but come with higher risks. Larger companies tend to grow more slowly, but offer steadier returns. Every IPO sends ripples through the economy, creating jobs and generating tax revenue. Successful IPOs inspire innovation and signal economic confidence. That's why nations encourage entrepreneurship. Every successful IPO injects new energy into the financial bloodstream of the world. When you buy your first share in an IPO, you're not just making a transaction. You're saying, "I believe in this company's dream." You're helping innovation move forward and turning ideas into reality. From the first spark of an idea to the ringing of the opening bell, this is a journey of destiny. A journey where ordinary people can own extraordinary dreams. Because every share tells a story, and one day, that story could be yours. The stock market isn't a casino. It's a mirror reflecting our emotions, values, and visions. Every candle, every chart, every number tells a story written by fear and confidence. It's the collective actions of millions buying and selling that shape this narrative. To truly understand this story, you need to learn analysis. In this chapter, we'll explore how professional investors view companies as living organisms, not just symbols on a screen. Chapter 1. The two pillars of stock analysis. All professional analysis rests on two strong pillars: fundamental and technical analysis. Fundamental analysis studies the business itself, while technical analysis focuses on price behavior. Fundamentals tell you what to buy. Technical analysis tells you when to buy. Together, they create the complete language of the market. Chapter 2. Understanding fundamentals, the business behind the stock. When you buy a stock, you're buying a piece of a business. So the first question is this a good business? To answer that, professionals examine 4 key dimensions. First, earnings growth. How has the company's profit evolved over the last 5 years? Growing earnings indicates strong demand and effective management. Next, revenue trends. Is sales growth consistent? Sudden spikes might signal one-time events, while steady growth shows stability. Then, we look at margins. Healthy profit margins mean the company retains more from every dollar earned. Finally, consider debt levels. Too much debt can sink a company in tough times. A lower debt-to-equity ratio is generally safer. These insights come from the company's financial statements, balance sheet, income statement, and cash flow report. When you see rising revenue,
even the best
expanding
company
margins,
can
and
be a bad
manageable
investment if you overpay.
you found a company built to
Valuation is
last.
key to understanding a stock's true worth. Let's start with the PE ratio, price to earnings. P/E is calculated by dividing the share price by earnings per share. A high PE might mean strong growth expectations or an overpriced stock. Always compare PE with competitors and historical averages. Next up is the PEG ratio, price/earnings to growth. PEG is found by dividing PE by the earnings growth rate. Values near 1 suggest fair pricing. Above 1.5 may be too expensive. Then we have book value and the PB ratio. Book value is total assets minus liabilities. PB is calculated by dividing the share price by book value per share. A lower PB can indicate undervaluation. Great investors like Warren Buffett use these tools wisely. They seek valuable businesses at reasonable prices, not just cheap stocks. But remember, numbers matter, but context matters more. A company must be compared within its industry. Who are its competitors? Does it have a unique advantage or a moat? A moat could be brand power, patents, or loyal customers. Think of Coca-Cola's recipe or Apple's ecosystem. When strong fundamentals meet an enduring moat, you've found potential. Now, let's talk about technical analysis. Reading the market's pulse. Fundamentals tell you what to buy. Technicals show when to buy. Every price move leaves clues. Recognize repeating patterns. An uptrend forms higher highs and higher lows. A downtrend forms lower highs and lower lows. Trade with the trend, not against it. Support is where price tends to stop falling. Resistance is where price struggles to rise. Buy near support, sell near resistance. It's that simple. Volume shows conviction. Rising price with rising volume means strong demand. Charts are visual psychology. Each candle tells a story. Each breakout reflects belief in the market.
Indicators are your best friends in the world of data. They simplify complexity and confirm probabilities, not predict the future. First up, moving averages. The 50-day and 200-day averages show long-term trends. When the short-term crosses above the long-term, it's a golden cross, bullish. But if it crosses below, watch out for the death cross, bearish territory. Next, we have the RSI, or Relative Strength Index. It ranges from 0 to 100. Above 70 means overbought, below 30 means oversold. Use it to spot potential reversals. Then there's the MACE, which shows momentum. When the MACD line crosses above the signal line, it's a bullish sign. Bollinger Bands measure volatility. If the price touches the lower band and RSI is low, it could be a rebound zone. Remember, use these indicators together with market structure for better results. Confluence equals confidence. Now, let's talk about timing your entries and exits. Patience is key. It separates the pros from the impulsive traders. Start by identifying the overall trend on a higher time frame. Then, zoom in for entry precision. Wait for confirmation. Look for candle rejections, RSI signals, or volume surges before jumping in. Always set your stop loss before entering a trade. And define your target before dreaming of profits. Good analysis isn't about being right all the time. It's about protecting your capital when you're wrong. Finally, risk management is crucial. Even the best analysis can fail without it. Never risk more than 2% of your capital on a single trade. Use stop-loss orders religiously. Diversify your investments. Don't put all your eggs in one basket. Remember, professionals survive not by winning every trade, but by keeping their losses small and letting their gains compound. So, how do you combine all this? First, start with the fundamentals. Focus on strong, profitable companies. Next, study valuation. Make sure the price is fair before diving in. Then, use technical analysis. Time your entries around support and resistance levels. And don't forget risk management. Limit your exposure and secure those profits. This framework is what analysts worldwide rely on, from Wall Street to every independent investor watching right now. The real power of analysis isn't just about prediction. It's all about preparation. When you learn to read a business and a chart, you stop reacting to the market. Instead, you start anticipating it. Every great investor began here, learning patterns, studying numbers, and yes, even failing. But they adjusted and grew from those experiences. Remember, knowledge doesn't guarantee profit, but ignorance, that guarantees loss. So, study hard, observe everything, question every price move you see. Keep in mind, the market rewards not the smartest, but the most disciplined.